Right now, while you're listening to this, there's a financial weapon sitting in the global economy, not a metaphor, an actual ticking bomb. $500 trillion in derivatives, that's 7 times the entire world economy connected, in a web so complex that not even the banks holding them fully understand what they own. Your savings account, your mortgage, your retirement fund, all of them are tangled in this web. And history has shown us what happens when these webs break. They don't fray slowly, they snap, violently, without warning. 1929, margin debt collapsed. The Great Depression began. 2008, mortgage derivatives exploded. Lehman Brothers vanished in 48 hours. Today, the bomb is bigger. The fuses are shorter. And we're watching the same match being lit. To understand where we're headed, we need to go back, not 2008, further. Because derivatives aren't new, the danger isn't new. What's new is the scale and our collective amnesia about what happened every single time before. History doesn't repeat itself exactly, but it rhymes. And right now, the rhyme is getting louder. Let me take you to Amsterdam, 1637. Tulip mania is in full swing. But here's what they don't teach you in school. It wasn't really about tulips, it was about derivatives. Dutch merchants created contracts called windhandel. Wind trade. You could buy the promise of a tulip bulb that didn't exist yet, from a garden that hadn't been planted, with money you didn't have. Sound familiar? At the peak, a single tulip bulb contract sold for 10 times the annual income of a skilled craftsman. Source: Tulip Mania by Mike Dash. 1999 people mortgaged their homes, sold businesses. All for paper promises of future flowers. Then came February 1637. A single auction failed. One buyer didn't show up. That's all it took. Within 3 days, tulip contracts lost 95% of their value. Within 3 weeks, the entire system collapsed. Here's the part that should terrify you. The tulip bulbs themselves were fine. The flowers still bloomed. But the derivative contracts, the bets on the flowers, those evaporated. And they took the savings of an entire merchant class with them. A baker named Jan van Dam had invested his life savings 12 years of earnings in tulip contracts. When the crash came, he lost everything in a single afternoon. His bakery, mortgaged for more contracts, was seized. Within 6 months, he was destitute. Source: Amsterdam Municipal Archives, 1637. That's what derivatives do. They don't just move money, they erase it. But humanity forgets. Always without fail. Fast forward to London. 1720. The South Sea Company creates what we'd now call complex financial instruments, essentially derivatives based on future trade profits from South America. Trade that mostly didn't exist, profits that were imaginary. But the contracts, those were very real. Isaac Newton? Yes, that Newton invested £4,000, his entire fortune. When the bubble burst, he lost everything. Source: The South Sea Bubble by John Carswell. He later wrote, "I can calculate the motion of heavenly bodies, but not the madness of people. The collapse destroyed the British economy for a decade. Thousands of families ruined. Parliament had to pass the Bubble Act to prevent similar schemes. The act stayed in place for over a century." Notice something: different century, different assets, same structure. Create complex financial instruments, convince people they're safe. Watch the value inflate beyond reality. Then watch it all collapse. The pattern repeats. Always. Now let me take you to September 14th, 2008. A Sunday night, Lehman Brothers, a 158-year-old investment bank, is hours from bankruptcy. The reason? Derivatives. Specifically, credit default swaps, insurance policies on mortgage bonds. But here's the deadly part. Banks were selling insurance on bonds they didn't own, to protect loans they didn't make, with money they didn't have. Lehman held $639 billion in assets, but they held derivatives contracts worth over $35 trillion. Check. We've got derivatives on derivative synthetics, CDOs, total return swaps, structured notes. Most bankers holding them can't explain how they work. Stage 2. Assure everyone they're safe and well regulated. Check. After 2008, we passed Dodd-Frank. The banks fought it. Water it down. Today, many key provisions have been rolled back. Source: Congressional Research Service, 2023, Stage 3. Allow leverage to build to unsustainable levels. Czech Deutsche Bank alone holds derivatives worth $47 trillion. That's more than the entire European economy. Source: Deutsche Bank Annual Report, 2023, JPMorgan Chase, 54 trillion in derivatives exposure. Source: Office of the Controller of the Currency, Q3 2024, Stage 4, experience a shock to the system. This is where we are now. Interest rates went from 0 to 5.5% in 18 months, the fastest increase in 40 years. Source: Federal Reserve, 2024, every derivative contract based on low rates is now underwater. Stage 5, that's the collapse. And history shows us it comes fast. The question isn't if, it's when. And what happens to your money when it does? I can't tell you the exact date, no one can, but I can tell you what to watch for. When you see major banks suddenly merging, that's a warning sign. When you hear about liquidity crises in markets you've never heard of, pay attention. When the Federal Reserve starts emergency measures and limited swap lines, discount window changes, the countdown has begun. And here's the most sobering truth. When it happens, your grocery bill will spike again. Your rent will become even more unaffordable. Your savings will evaporate further, because the solution to a derivatives crisis is always the same: print money. Bail out banks and let inflation eat away at everything you've worked for. 5 empires, 5 financial explosions, from tulips to mortgages to derivatives. Different assets, same structure, same warnings, same ending. They thought they were different. They thought they'd learned from the past. They thought this time was special. They were wrong. Every single time. So here's what I can't stop thinking about. We're watching the biggest derivative bubble in human history. It's 7 times larger than the entire world economy. It's interconnected in ways no one fully understands, and the interest rate shock has already begun. Are we the generation that finally learns? Or are we just the next chapter in a very old story? Look at your last grocery receipt. Then ask yourself, is this normal inflation? Or is this a warning sign that something much bigger is breaking? So let me ask you this. When did you first notice things changing? Was it the grocery store? The rent increase? Your retirement statement? Drop a comment. Read every single one. And if you're seeing these patterns too, hit subscribe, because next week we're diving into the one move that could change everything, the decision no empire has ever made. You won't want to miss it. Thank you for watching this through. If this makes you think differently about your money, subscribe. More patterns, more history, more truth every week. I'll see you in the next one. Source: Lehman Brothers. Bankruptcy filing. 2008, when the housing market dipped just 20%, those derivative positions exploded. The bank didn't decline, it vaporized, and they weren't alone. Bear Stearns collapsed in March. AIG needed $182 billion in bailouts. Source: U.S. Treasury Department, 2008-2009. Why? Derivatives. All of them were selling insurance on assets they didn't understand, using models that assumed housing prices would never fall. But they did fall, and the web connecting every major bank started breaking strand by strand. Sarah Chen was a compliance officer at a regional bank in Ohio. She watched her retirement account 30. Source: PBS Frontline Interview. The warning: 2009, her bank held mortgage-backed securities they thought were safe, AAA rated, but underneath were derivative contracts 12 layers deep. When the mortgages failed, the entire structure collapsed like a house of cards. I followed every rule, she told interviewers. I trusted the rating agencies. I believed the models. And I lost everything anyway. That's the nightmare of derivatives. You can do everything right and still lose everything because someone else, someone you've never met, made a bet you didn't know existed. The 2008 crisis required $16 trillion in bailouts and guarantees to stabilize. Source: Federal Reserve Audit. 2011 unemployment hit 10%. Source: Bureau of Labor Statistics. 2009, 9 million families lost their homes. Source: CoreLogic Foreclosure Report, 2012. But here's what they didn't fix: the derivatives market. In 2008, the global derivatives market was worth around $600 trillion. Today, it's somewhere between $600 and $1 quadrillion, depending on how you measure. Source: Bank for International Settlements. 2024, the bomb didn't get diffused, it got bigger. Let me explain what $500 trillion actually means. The entire US GDP is 27 trillion. Source: Bureau of Economic Analysis, 2024, the whole world economy, around 105 trillion. Source: World Bank, 2024, these derivative contracts are worth 5 times everything humanity produces in a year. 5 times. And here's the terrifying part: they're interconnected. Bank A holds a derivative contract with Bank B, who has a contract with Bank C, who sold protection to Bank D. If any one link breaks, the entire chain can collapse, systemically, instantly. Remember, Credit Suisse, March 2023. I am 167 years old. Collapsed in 3 days. Source: Financial Times, March 2023, the trigger. Derivatives, exposure, and counterparty risk. UBS had to absorb them in an emergency weekend merger. The same month, Silicon Valley Bank failed. The 16th largest bank in America, gone in 48 hours. Source: FDIC, March 2023. They held long-term bonds, but derivative traders bet against them. The bets became self-fulfilling. 2 major banks, same month, same pattern. Different details, same ending. So what does this mean for you? For your grocery bill, your rent, your savings? When derivatives explode, central banks respond the same way every time they print money. Lots of it. In 2008, the Federal Reserve created $4 trillion out of thin air. Source: Federal Reserve Balance Sheet, 2008 to 2014. That money doesn't disappear. It flows into the economy, and it devalues every dollar you've saved. Your grocery bill knows this. Eggs that cost $2 in 2020 cost $6 today, a 200% increase in just 4 years. Source: USDA National Retail Report, 2024. That's not random. That's the echo of money printing from the last crisis still rippling through the system. Your rent? Average rent in major U.S. cities increased 30% since 2020. Source: Zillow Rent Index, 2024. Why? Because institutional investors, flush with cheap money from the Fed, bought up housing inventory. They could afford to, you can't. Your savings, if you saved $10,000 in 2020, its purchasing power today is around $7,800. Source: CPI Inflation Calculator, Bureau of Labor Statistics. You lost 22% without spending a penny. And your retirement? The average 401k balance for Americans aged 55 to 64 is $120,000. Source: Vanguard, 2024. Financial advisors say you need at least $1 million to retire comfortably. The gap is devastating, and it's growing. But here's what keeps me up at night. This isn't a theory. This isn't fear-mongering. This is pattern recognition. Stage 1. Create complex financial instruments that few understand.